All right, let's dive into the global macro outlook for 2025. We're going to break down the MacroMemo report from RBC Global Asset Management, dated January 27th. Think of this as your cheat sheet to what's driving the world economy. Now, remember all those recession warnings we were hearing about?
Oh, yeah.
They've quieted down. The economic picture. It's anything but simple. We've got a potentially overheated U.S. economy, inflation that just won't quit, a new U.S. administration shaking things up, and Canada? Well, Canada's facing its own unique hurdles.
Yeah, it's definitely a fascinating time to be watching the markets right now.
Absolutely. So let's start with the global stage. Good news is, no looming recession. The global economy is still projected to grow, but it might be a bit slower than we've seen in recent years. And
inflation.
It's stubbornly sticking around.
Yeah. One of the interesting shifts the report highlights is this move from fears of a crash landing to worries about a no landing scenario, essentially. Instead of a sharp economic downturn, we might be looking at an economy that runs too hot.
That sounds almost good. Is a no landing something we should actually be worried about?
Well, an overheating economy can lead to some serious issues. Think about runaway inflation, asset bubbles that could burst, and potentially even a sharper correction down the road.
So not exactly a smooth flight, then. The report points to the U.S. economy as a potential outperformer, with predictions that it will do better than other countries. What's fueling that optimism?
Well, part of it is what economists call animal spirits.
Animal spirits.
Yeah, it's that surge of optimism and confidence. That often follows a major political event, in this case, the recent U.S. election.
Right.
And this can lead to more investment and spending, which in turn drives economic growth.
So is this like a sugar rush for the economy? Could this particular surge in animal spirits fizzle out faster than in previous cycles?
That's a great question. It's possible that this post-election optimism is more fragile than in the past, especially given the many uncertainties surrounding the new administration's policies.
Okay, so let's unpack those uncertainties. We've got new policies around tariffs, immigration, government spending cuts. It feels like a lot is up in the air.
There's certainly a lot to digest. The political landscape is always a wild card. And a new administration with a new agenda inevitably brings changes.
Yeah.
There's been a lot of talk about spending cuts, especially with a Republican-controlled Congress. But the report suggests that major programs like Social Security and Medicare are unlikely to see any drastic cuts.
So no massive overhaul of those programs, but what about smaller adjustments? Could those have a significant impact?
It's possible. The report suggests they'll likely focus on individual program adjustments to find savings, rather than sweeping changes that could disrupt the economy.
Gotcha. All right, let's move on to tariffs. It's a topic that always seems to be on everyone's mind. Is this the beginning of a full-blown trade war, or more of a strategic move by the new administration?
Well, the report sees tariffs more as a negotiating tactic, a way for the U.S. to try and get concessions from its trading partners. They're likely to be more targeted than widespread. But the severity will depend on how those negotiations unfold.
So a lot depends on how those trade talks play out. And what about China? They've been a major target of U.S. tariffs in the past. Will they bear the brunt of these new policies, or are they better positioned to weather the storm now?
That's a key question. The report suggests that China might not be as vulnerable to tariffs as some fear.
Okay.
Their exports are more diverse now, meaning they're not as reliant on the U.S. market as they once were.
Interesting. So maybe not a knockout blow,
Yeah.
but I imagine there are other pressure points in the U.S.-China relationship beyond just tariffs.
Absolutely. Restricting China's access to key American technologies and resources is a big one.
Yeah.
That's where things can get really tense and have significant global repercussions.
Hey, speaking of tension, let's not forget about the debt ceiling drama. It feels like this issue comes back to haunt us every few years. What's the outlook this time around?
Unfortunately, the debt ceiling issue is looming again, and that almost guarantees some market jitters and political headaches.
Well, given the historical context of these debt ceiling standoffs, is the market overreacting, or are there genuine concerns that this time could be different and lead to an actual default?
While a full-blown default is very unlikely, historically these showdowns tend to get resolved at the last minute. But it's still a risk factor. It could create short-term volatility in the markets.
So maybe keep those antacids handy for when the news cycle inevitably ramps up the anxiety. Around the debt ceiling, we've talked a lot about the global picture and some of the uncertainties. surrounding the U.S. economy, but the report does point to some positive signals for the U.S. as well, right?
Yes, there are some positive signs. Job growth is still looking good, and some of those recession indicators that were flashing red a few months ago have mostly dimmed.
Okay.
But it's not all smooth sailing.
Well, that's what we're here to unpack. What are some of those potential bumps in the road for the U.S. economy?
Well, we're seeing signs of moderation in the U.S. economy. Growth is likely to be slower compared to last year. And then there's inflation. While it is cooling down, it's not happening as quickly as in other developed nations.
So the U.S. is playing catch-up when it comes to taming inflation. Why is that? And what are the implications?
That's right. And it's a big reason why the Federal Reserve, the U.S. Central Bank, is being cautious about cutting interest rates too quickly. They don't want to inadvertently fuel inflation further.
Speaking of the Fed, they've been lowering interest rates recently. Is the expectation that they'll continue on that path?
The expectation is that they will continue easing interest rates, but they'll likely do it more gradually than some might hope. They're in a tricky position, trying to support economic growth while also keeping inflation in check. It's a delicate balancing act.
They're walking a tightrope, and the report suggests the Fed might have more room to maneuver than the market thinks, right?
Yes. That's a fascinating point. The market seems to think the neutral interest rate, the rate that neither stimulates nor restricts the economy, it's above 4%. But RBC, Global Asset Management, suggests it's closer to 3%.
Okay.
This means the Fed might have more wiggle room to cut rates further down the line without sending inflation spiraling out of control.
So potential silver lining there. But let's shift gears for a moment and head north of the border to Canada. What's the economic picture looking like there?
Well, Canada's entering a period of significant political uncertainty with Prime Minister Trudeau's recent resignation.
Wow.
The country's heading towards a federal election in 2025.
Yeah.
And the possibility of a conservative majority government is looking increasingly likely.
Whoa, big changes on the horizon. How could a potential change in government impact the Canadian economy?
What new government always brings the potential for policy shifts, which can create uncertainty. For businesses and investors, we'll have to wait and see what their priorities are, but it's definitely something to watch closely.
On top of the political drama, the Canadian dollar has been struggling lately. What factors are contributing to this weakness?
There are a few things at play. Ongoing tariff concerns have spooked investors, as has the Bank of Canada's more dovish stance on interest rates, meaning they're more inclined to lower rates to stimulate the economy. Plus, Canada's economic growth has been a bit sluggish lately.
So a bit of a perfect storm brewing there. But some analysts argue that the fundamentals of the Canadian economy justify the decline in the dollar. How does the report reconcile those viewpoints? Is the market overreacting, or is this a legitimate correction?
That's where things get interesting.
Yeah.
The report suggests that the market might be overreacting a bit. They don't see a complete collapse of the Canadian dollar. In fact, they believe there's a good chance it could rebound in the medium term if those tariff fears subside and the global economy stabilizes.
Okay, so maybe a glimmer of hope for the loonie. What about the Bank of Canada? What's their plan of attack in this environment?
They're expected to continue cutting interest rates to try and stimulate the economy. Unemployment is rising, and many Canadians are facing higher mortgage payments as their loans come up for renewal. The Bank of Canada wants to ease that pressure and keep the economy afloat.
So lower rates to the rescue. But are there any potential downsides to this strategy?
There are always trade-offs. While lower rates can stimulate the economy, they can also lead to higher inflation down the road. Plus, there's a major review of the Bank of Canada's mandate coming up, which could change how they make decisions and what your priorities are.
That sounds like a potential game changer. Can you delve a bit deeper into what specific changes might be considered as part of this mandate review and how those changes could impact the Bank of Canada's approach to monetary policy?
Of course, one key area being examined is whether the Bank of Canada should formally adopt a dual mandate, similar to the U.S. Federal Reserve, which focuses on both inflation and employment. Currently, the Bank of Canada's primary focus is on controlling inflation.
So potentially a big shift in how the Bank of Canada operates. It's fascinating how even seemingly technical changes like this can have such a huge impact on the economy. This report has really underscored how interconnected the global economy truly is.
Absolutely. It's like a giant web, where even small tremors in one part can be felt across the entire system.
We've talked about tariffs and trade tensions, but what are some other examples of this interconnectedness. That stood out in the report.
Well, the report highlights how events far beyond our borders can impact us here at home. Take climate change, for instance. Extreme weather events are becoming more frequent and intense, disrupting global supply chains and leading to higher costs for everyone.
That's a great example. It's a stark reminder that the climate crisis is not just an environmental issue, it's an economic one too. And speaking of global challenges, inflation is still a major concern. It's cooling down, but not as quickly as many had hoped. What's the long-term outlook, according to the report?
The report suggests that inflation is likely to remain elevated for a while, longer than many central banks initially anticipated. A confluence of factors, supply chain disruptions, pent-up demand from the pandemic era, and rising energy prices.
So no quick fix on the horizon. Does the report offer any insights into how central banks are approaching this challenge of taming inflation without triggering a recession?
Central banks are in a really tough spot. They're raising interest rates. But very cautiously, they're walking a tightrope, trying to cool down the economy without causing it to stall out completely.
It sounds like they need nerves of steel. Are there any other major risks on the radar beyond inflation that could derail the global economy?
Geopolitical risks are always a factor. We've talked about the trade tensions between the U.S. and China. But there are other potential hotspots as well. Political instability in certain regions, energy security concerns, the threat of cyber attacks. These are all things that could impact global markets.
It's a lot to keep track of. With all these complex forces at play, it's easy to feel overwhelmed. What advice would you give to someone who's trying to make sense of all this and make informed decisions about their personal finances?
The most important thing is to stay informed, but don't just consume headlines. Dig deeper. Look for reputable sources of information and try to understand the different perspectives and potential scenarios that could play out.
So don't bury your head in the sand, but also avoid getting swept up in the hyper-panic of the moment.
Exactly. And don't be afraid to seek out expert advice. Talk to a financial advisor. Do your research. And make sure your investments are aligned with your individual goals and risk tolerance.
That's great advice. Now let's circle back to the U.S. economy for a moment. The report predicts it will outperform other developed nations, but there are some potential challenges as well.
Yes. The report flags a few key things to watch, particularly with the Federal Reserve. They're facing intense pressure to control inflation, which could lead to some difficult decisions down the road.
So potentially even higher interest rates than anticipated, which could then slow economic growth. Is that the trade-off they're grappling with?
Precisely. And then there's the political landscape. The U.S. remains a very divided country politically, which can make it difficult to implement effective economic policies. Gridlock in Washington is rarely good for the economy.
Okay, so some potential headwinds for the U.S. to navigate. Let's shift our focus back to Canada. We've touched on the upcoming election and the weakening Canadian dollar. What other key insights does the report offer about the Canadian economy?
One interesting point the report raises is about the housing market. Canada has experienced skyrocketing housing prices in recent years, leading to concerns about a potential bubble.
That's been a big topic of conversation here in Canada. Is the report predicting a crash?
They don't foresee a full-blown crash, but they do caution the prices could cool down significantly, especially if interest rates continue to rise. It's something for both current and prospective homeowners to keep in mind. Definitely something to watch closely. And what about the energy sector? That's a big part of the Canadian economy. What are some of the trends and challenges it's facing?
The Canadian energy sector is at a crossroads. The global shift toward cleaner energy sources is putting pressure on traditional oil and gas companies. There are also ongoing debates about pipelines and environmental regulations, which create uncertainty for the industry.
It's a lot of moving pieces. In the Canadian energy landscape, what's the overall takeaway from the report about the global economic outlook?
I think the key message is that the global economy is in a state of transition. There are a lot of factors at play, and it's possible to predict the future with certainty. But by staying informed, being adaptable, and making thoughtful decisions, we can navigate these uncertain times and come out stronger on the other side.
I appreciate that balanced perspective. It's easy to get caught up in the doom and gloom, but it's important to remember that the economy is cyclical. There will always be ups and downs. Exactly. The key is to avoid making rash decisions based on fear or greed. Stay calm, stay informed, and focus on the long term.
We've covered a lot of ground today, from global inflation to the Canadian housing market. But let's zoom out for a moment and consider the bigger picture. What are some of the key insights you've gleaned from this report?
For me, the biggest takeaway is how interconnected the global economy truly is. Events in one corner of the world can have ripple effects across the entire system. It's more important than ever to have a global perspective and understand how these global trends might impact us locally.
I completely agree. And for me, the report was a reminder that economic forecasting is not an exact science. There are always surprises, unexpected twists and turns.
Absolutely. It's not about predicting the future with perfect accuracy. It's about understanding the forces at play, the different scenarios that could unfold, and being prepared to adapt as things evolve.
It's about having a framework for understanding the world around us and using that knowledge to make informed decisions. That's where reports like this one from RBC Global Asset Management can be so valuable. They provide a snapshot of the current economic landscape, highlight the key trends to watch, and offer insights into what the future might hold.
It's like having a roadmap, not a GPS. It gives you a sense of direction, helps you anticipate potential roadblocks, and allows you to make adjustments along the way.
That's a great analogy. Now, before we wrap up this deep dive, I want to leave our listeners with a thought to ponder. We've discussed the big picture, but how do these global economic trends translate to your own personal financial situation?
That's the key question. Ask yourself, what are your financial priorities? Are you saving for retirement, a down payment on a house, or your children's education? How might these global economic trends impact your ability to achieve those goals?
It's about connecting the dots between the global and the personal. What concrete steps can people take to make sure their finances are aligned with these broader economic forces?
First, take some time to review your budget and see if there are any areas where you can cut back or save more. Second, explore ways to increase your income, whether it's through a raise, a side hustle, or finding ways to monetize your existing skills.
So be proactive and take control of your financial situation.
Exactly. And finally, think about how you can make your money work harder for you. Explore different investment options, shop around for better deals on your expenses, and make sure you're getting the most out of your hard-earned money.
Solid advice. And as we discussed earlier, don't be afraid to seek out professional guidance. Talk to a financial advisor who can help you develop a personalized plan that aligns with your goals and risk tolerance.
Absolutely. Financial planning is not a one-size-fits-all endeavor. It's about finding what works best for you and your individual circumstances.
Well, folks, that brings us to the end of part 2 of our deep dive into the global economic outlook. I hope you're finding this conversation as thought-provoking as I am.
We've covered a lot of ground, but there's still more to explore.
In part 3, we'll take a closer look at some specific implications of the RBC Global Asset Management Report. For investors, we'll delve into asset valuations, interest rate trends, and what it all means for your portfolio.
We'll also discuss some strategies for navigating these uncertain economic times and how to position yourself for long-term financial success.
Stay tuned for the final part of our deep dive. We'll be right back after a short break. Don't go anywhere.
Welcome back to the deep dive. As promised, we're going to unpack some specific implications of the RBC Global Asset Management Report for investors.
It's one thing to understand the broader economic trends, but what does it all mean for your portfolio? That's what we'll focus on in this final segment.
Let's start with the U.S. We've discussed how the report suggests the U.S. economy is poised to outperform other developed nations. But there's a catch for investors, right?
Yes, that's a key point the report makes. This anticipated outperformance may already be baked into U.S. asset prices. Stocks, bonds, real estate, they may already reflect this positive outlook. So jumping into the U.S. market right now might not be the sure bet some people think it is.
Exactly. It's not about saying the U.S. is a bad investment, but investors need to be mindful of valuations. Don't assume that past performance is a guarantee of future returns.
Okay. A dose of caution is warranted. What about those looming interest rate cuts by the Federal Reserve? How should investors be thinking about those?
Well, the report suggests the Fed will likely ease interest rates, but at a gradual pace. For borrowers, this is generally good news. Think about mortgages, business loans, even credit card debt. Lower interest rates usually translate to lower borrowing costs.
So potential relief for those carrying debt. But what about for people who are saving and investing? How will those rate cuts affect them?
On the flip side, lower interest rates can mean lower returns on savings accounts and some fixed income investments. It's all about understanding the trade-offs and finding the right balance for your individual circumstances.
Makes sense. It highlights the importance of having a diversified portfolio that can adapt to different interest rate environments. Let's talk about the Canadian dollar. It's been weakening lately, and that can be unsettling for investors. What does the report say about the loonies' prospects?
The report offers a slightly contrarian view here while acknowledging the Canadian dollar has weakened. RBC Global Asset Management believes the market might be overly pessimistic.
So perhaps there's no need to sound the alarm bells just yet.
Exactly. They see potential for the Canadian dollar to rebound in the medium term, especially if those trade tensions ease and the global economy stabilizes.
That's encouraging news for those who hold Canadian assets. Now let's shift gears to one of the biggest economic challenges facing everyone, inflation. It's been eating into everyone's budgets. Are there any specific insights from the report about how investors can protect themselves from rising prices?
Inflation is definitely a top concern for investors right now. The report suggests a few strategies to consider. First, it might be worth revisiting your asset allocation. Think about incorporating assets that tend to perform well during periods of inflation, such as commodities or real estate.
So diversifying beyond traditional stocks and bonds. Are there other strategies investors should consider?
It's also a good time to review your investment expenses. High fees can erode your returns, especially in an inflationary environment. Make sure you're not paying more than you need to in management fees or trading commissions.
It's about being a savvy investor, not just in terms of what you invest in, but also how much you pay to invest.
Precisely. And finally, don't forget about the power of long-term thinking. Inflation can be unsettling in the short term, but over the long run, the stock market has historically outpaced inflation.
So don't panic and sell off your investments. Just because prices are rising, stay focused on your long-term goals.
Exactly. It's about staying disciplined and not letting short-term market fluctuations derail your financial plan.
Well, we've covered a lot of ground in this deep dive into the global economic outlook. We've explored the big picture trends, the potential risks and opportunities, and some specific strategies for navigating these uncertain times.
It's been a fascinating discussion. I always enjoy unpacking these complex issues and helping people understand how they can make informed decisions about their money.
Me too. I hope our listeners feel empowered to take control of their financial future. Remember, knowledge is power, and the more you understand about the forces shaping the world around you, the better equipped you'll be to achieve your financial goals.
Absolutely. It's been a pleasure joining you for this deep dive.
And to our listeners, thank you for joining us on this journey. We encourage you to keep exploring, keep learning, and keep diving deep. Until next time.